Hey everybody, Jeff Garber, mortgage expert, coming at you with good news finally. Today is November 10th. We've had this day circled on the calendar for a while. And kudos to Barry Habib and Dan Habib and the entire team. They're economic forecasters in the housing market that I follow very closely and have learned a lot from over the years, and they nailed this. Absolutely nailed this. And now I want to share it with you. I've been talking to realtors and consumers about this for months now, and there's been a lot of naysayers saying that there's just no signs of inflation ever coming down again, and this country's a mess, and mortgage rates are going to stay high forever. And I all along have been saying, look, we just don't think so. And today is the first day that we have proof that things are working the way we thought they would work. And that was in the measure of the CPI, or Consumer Price Index. And what we look at specifically is called the core CPI, which strips out very volatile food and energy. The core CPI is what the Federal Reserve can control. The Fed has been aggressively hiking rates. We all know that. They've been doing that since March of 2022. They took the training wheels off of the economy in June of 2022, meaning they stopped doing any sort of quantitative easing, meaning buying securities like mortgage-backed securities to make rates artificially lower. So the training wheels were off and the hikes began, and we all saw mortgage rates continue to rise. We all saw inflation continue to rise, but we had this date marked. We had a good reason why. Let me show you that now. I want to pull up a chart that will explain what we've been thinking about here. So I got the chart up. Let me get myself out of the way here. What you're looking at right now is basically the way the core inflation readings work. These July, August, and September numbers here, these are from 2021. And look how low they are, 0.3, 0.2, 0.3. They were low readings on inflation. Now, what happens is we had July, August, and September of this year come around, and we knew that if the numbers that came out this year, July, August, and September, were higher than they were a year ago, well, that inflation would rise. And we knew that it was going to be a lot of tough sledding. Okay. And we saw July's number 0.3. That cancels July's of the year before in 21. August was 0.6, replacing a 0.2. And September was a 0.6, replacing a 0.3. So we knew we were going to have some tough sledding in the fall. And we knew that inflation numbers were going to be hot or higher. And we know mortgage rates really go in the same direction as inflation. So it wasn't a surprise to us that rates continued to go up. But if we further look at this chart, we see October of 21 and November, December, January, all having higher numbers. Well, because the Federal Reserve's been hiking rates, they do that on purpose to slow the economy down. And when the economy slows down, typically people stop spending. They don't spend as much, and inflation starts to come down. And we figured that the November reading of inflation, which is really for October, is going to replace this high October reading. Well, look what happened. Today, that CPI came out at 0.3. That replaced a high number of 0.6. So our 12-month year-over-year average now decreased from 6.6 to 6.3. And we had the first look at the potential of inflation starting to either peak or level out here. And that's great news. Well, if we get this chart out of the way, how did the bond market react? Well, look at this monster coupon, green candlestick here today. All right, this what you're looking at now, which I show a lot, are mortgages trading every day in the bond market. And you can clearly see a big green candlestick. We love it. And as the bond market price goes up, mortgage rates come down. So if you look at today, that's all because of inflation, the inflation number coming out better than we expected. And this could be the start of what we saw in that chart, where we're going to get some lower numbers replacing higher numbers, and we'll see inflation come down. Now, in the bigger scheme of things, that would mean, because we know the Federal Reserve is watching us, that maybe this upcoming Fed meeting in December, maybe that's the last hike. Maybe that 3/4 point hike is the last one, and the Fed takes their foot off the pedal and hikes. And so the stock market and bond market and rates, everybody would kind of love that if we know that the Federal Reserve is going to stop hiking short-term rates. All right, now we needed them to do that. We needed them to get in front of inflation. They did a terrible job. They let it get too far before they started hiking rates. And hikes take 3 to 6 months, each one, for it to be felt in the economy. So if they started hiking in March, all right, in a recap here, they started hiking in March. It's now November. They've done several 3/4 point hikes, along with a quarter in there as well. And we are now finally starting to see the hikes do what they're supposed to do. Right now, unfortunately, the Fed may overhike and they could slow the economy down and unfortunately probably send us into recession. And I've talked about that a little bit before, and that definitely could happen. But that's not a bad thing. We have to get through this and let it play out so that we can get back into, if you want to call it, a quote unquote normal housing market. And a normal housing market right now looks like we want to see rates come down. If rates come down, we think more buyers will come into the market. We're still going to have low inventory. And so in the future here, we may end up being back where we were before the rates started really going up. In other words, if rates come down, more people want to sell and more people want to buy, but inventory still stays low relative to everything, then we could be back in a market where there's more buyers than there is inventory, which means there'll be multiple offers. And we get back into that, you have to go over ask, and we run into the appraisal gap issues. But look, we would have a housing market that's moving instead of stalling out due to high rates. There will be a reason for people to want to buy homes. Now, I don't want to get too far ahead of myself. This was just the first reading. We're excited because we've been calling it and we've been sharing this with realtors and consumers on why we still think it's a good time to buy right now. And for this to have played out the way we have been saying is just wonderful news. Now we have to see what happens with our spending in December, January, February. If the inflation numbers continue to go in this pattern, we will see mortgage rates come down. And when we see mortgage rates come down, we'll see people feeling much more confident about the housing market. So I wanted to share that with you. This is kind of a big deal. That movement that I just showed you on the bond market here with this candle being as big as it is a decrease of at least 1/4 to 3/8 better in interest rate than we were yesterday. That's how impactful this is today. Now we got to see what happens tomorrow, if this is a little bit of an overreaction and if we give some of it back. But this was a good sign. This is what we wanted to see. We are heading in the right direction. We do see some better times ahead in the housing market, and this is just the start of it. Wanted to bring that to you. If you have any questions at all, please reach out to me. Happy to discuss this to you in much more detail. Very tough to do in 7-8 minutes, but I wanted to get the main point out there that, rates are coming down. It looks like they've been coming down the last 4 or 5 days. We've had some nice green candles. We want to see the bonds rise in price. Want to see that pattern continue. And again, we're hoping for some good times ahead. So I hope you have a great day. Reach out to me if you have any questions, and I will be back with updates as we make our way through this market.